Hello and welcome to the free cash flow video. And so first we'll start off with what is free cash flow. And we'll first start with the definition, and that is the amount of cash generated each year that is free and clear of internal and external obligations. And so to go into more depth on what free cash flow really is, it's the money left over after outflows for operations and maintaining capital assets. It's also can be used as a measure of profitability, excluding non-cash expenses. And then it also can show money that can be used for dividends, interest payments, and for payments to other creditors. And so investors like to look at this for those specific reasons. And so now we'll move on to why free cash flow is important. And I'll do this by showing what free cash flow tells us. And so free cash flow, as previously stated in the video, shows the money that the company can use to pay dividends, creditors, or use to sustain the company and possibly growth. If you have consistently negative free cash flows, this can be bad for the company. And this is because if you have bills to pay, whether it be employee salaries or you just need to pay creditors, but you do not have the cash to do it, the company will not be able to continue operations. In the early stages of the company, however, negative free cash flow is common because it takes time to scale the business to be profitable. Investors do want to have an idea of how the company could eventually show positive free cash flow in a timely manner. And this is because a company with positive free cash flows has the ability to support itself, create growth, and possibly see the investor receive a dividend from the company. Hello and welcome back to the free cash flow video, and now we'll take a look on how to actually calculate free cash flow. And so the equation for free cash flow is no plat plus depreciation minus change in net working capital minus net capital spending. And now I'll go into the specific calculations that go into each of those components. And the first one is no plat, and that formula is operating income times 1 minus the tax rate. And in this video, we'll assume a tax rate of 26%. And as you can see from the Manufacturing Inc.'s income statement, their operating income is $13,833 times the tax adjustment, which gets you a no plat of $10,236. And next we'll look at the change in net working capital. And so that's the difference between current assets and current liabilities from the current year and the previous year. And in this example, PP&E is the only fixed asset in the example. And so if you look at Manufacturing Inc.'s balance sheet, you'll see that the difference between current assets and current liabilities in the current year is $52,000. And in the previous year, 2023, you can see that the difference is $39,400. And so you then take the difference between those two numbers, which gets you a change in net working capital of $12,600. And now we'll take a look at net capital spending. And so that's the difference between the fixed assets in the current year and the previous year. And then you also add in the depreciation. And so you can see from the example that the current year's fixed assets are $20,000 and the previous year's fixed assets are $18,000. So you can see that they've spent $2,000 on fixed assets. And then also if you look at 2024's depreciation, which is the next portion of the calculation, you add back in the $667 from that line of depreciation, which gets you a final net capital spending of $2,667. And so now we'll put it all together. And so you take the no plat, you add back in the depreciation, take out the change in net working capital, and then also take out the net capital spending. The resulting number is the calculation for free cash flow, and you can see that there is a negative $4,364 free cash flow. So now we'll take a look at one last piece that affects free cash flow, and that is what's known as seller's discretionary earnings. And so seller's discretionary earnings is how much money a company's owner takes out for essentially what is a paycheck, and it is commonly seen on the financial statements as something called an owner draw. If SDE is present in a company, the free cash flow calculation needs to be adjusted, and the SDE, or the owner draw, needs to be added back into the company. This is because if an investor is looking to buy a company, the current owner would likely no longer be able to take out an owner draw because someone else owns the company. The money that they used to take out for their draw would essentially return back to the company, and that is why it needs to be accounted for. And that wraps up the free cash flow video. Thank you for watching.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.